So you want to understand the American economy. $31 trillion a year. The largest single pile of economic activity ever assembled by any society at any point in human history. 340 million people, the world's reserve currency, the deepest capital markets on earth, and a government that can borrow more cheaply than almost anyone alive. And everyone will tell you the same thing about it. They'll tell you it's a consumer economy. 7 out of every $10 is American households buying stuff. That's the line. It's in every textbook. Now look at the first quarter of this year. The economy grew at an annualized rate of about 2.1%. And roughly half of that growth came from one line item in the national accounts: computers and peripheral equipment, servers, chips, the physical guts of data centers. That category is somewhere around 3 or 4% of the economy. Household consumption, all of it, every car, every grocery run, every rent check, every doctor's visit, 68% of GDP, contributed roughly the same amount to growth as a sliver about 20 times smaller. Sit with that, because it's the single most important fact about the United States in 2026, and almost nobody says it plainly. There are 2 American economies right now running at 2 different speeds, stacked on top of each other. There's a very small one building computing infrastructure at a pace that some analysts now compare to the railway boom of the 1800s. And underneath it, there's a very large one. The one with the jobs and the groceries and the mortgages that is barely moving. The headline number you see on the news is the 2 of them added together, which means the headline number is telling you almost nothing about which economy you personally live in. So let's take the whole thing apart. We'll open the accounts, we'll walk through what actually produces the money, who holds the debt, what the Federal Reserve is doing and why it's split, what the tariff wars actually cost and who paid, and what happened to the American worker in a year when unemployment fell for reasons nobody is happy about. By the end, you'll be able to read an economic headline the way an analyst reads it, knowing which number is real, which is a rounding error, and which one is quietly doing all the work. Fair warning, some of this is uncomfortable regardless of your politics. I'm going to give you the figures and the honest disagreements around them, and let you do your own arithmetic. First, the measuring stick, because if you don't understand GDP, you will be misled by it constantly. Gross domestic product is the market value of everything produced inside the country's borders in a year. Inside the borders, that's the trick. A Japanese car maker building trucks in Kentucky counts as American GDP. An American firm's factory in Vietnam does not, and it's assembled from 4 buckets. You'll hear economists call it C plus I plus G plus net exports. C is consumption, households, roughly 2/3 of the whole thing. And here's the part people miss. Most of it isn't goods at all. It's services, healthcare, rent, insurance, education, software subscriptions. When you picture the American consumer, you probably picture a shopping trolley. You should be picturing a health insurance premium. I is investment, not stocks. That's a different thing entirely. This is business spending on things that produce future output. Factories, equipment, software, research, and new housing. It's the smallest of the big buckets and by far the most violent. Consumption drifts, investment lurches. Almost every recession in modern American history is a story about investment falling off a cliff while consumption sags mildly. G is government. Federal, state, and local purchases and investment. Important, this is what government buys, not what it sends. Social Security checks and Medicare payments are transfers. They move money from one pocket to another, and they get counted later when the recipient spends them. Miss that distinction, and you'll wildly overestimate the government's share. And net exports, exports minus imports. Since America buys more from the world than it sells, this number is negative, and it subtracts from GDP. Now, the most misunderstood sentence in all of economics: imports subtract from GDP. People hear that and conclude imports make the country poorer. They don't. The subtraction is bookkeeping, not judgment. Consumption and investment are measured as total spending, including spending on foreign-made goods. If you didn't subtract imports back out, you'd be crediting America for manufacturing done in Taiwan. The minus sign is an accounting correction, not a wound. This matters enormously this year because an extraordinary volume of the hardware in the AI build-out is imported. So the same boom shows up twice, once as a huge positive in investment and once as a huge negative in trade. In the second quarter, imports grew faster than exports, and net trade knocked about a full percentage point off headline growth. One last measuring stick problem, and it's the one that ruins most public arguments: real versus nominal. Nominal growth includes price increases, real growth strips them out. If output is flat, but every price rises 5%, nominal GDP grows 5%. And the country produced not one extra thing. Every serious growth figure you hear should be real. Every record high figure you see on social media is usually nominal and usually meaningless. So what does America actually do all day? If you had to compress the answer into one sentence, the United States sells services and ideas to itself and to the world, and buys physical objects from everyone else. Look at the trade figures, and it's stark. In a recent month, the country ran a goods deficit of around $100 billion and a services surplus of nearly $30 billion. That's the whole American economic model in two numbers. It is a net importer of things and a net exporter of expertise: finance, software, engineering, entertainment, tourism, education, licensing. The four biggest slices of the domestic economy, roughly, are these: finance, insurance, and real estate. The largest single block, and a very large chunk of it is imputed. The national accounts include an estimate of the rent homeowners would pay themselves if they were tenants. It's not fake, and every rich country does it, but it means a meaningful part of the American economy is a calculation about housing rather than a transaction anyone made. Professional and business services, consulting, law, accounting, engineering, design, software, ideas billed by the hour, healthcare, somewhere around a sixth to a fifth of the entire economy, a share no comparable country comes close to. And this is where you have to be careful about what GDP means. GDP measures spending, not value. If Americans pay twice as much for a hip replacement as Germans, and both patients walk out fine, America's GDP is higher and America is not better off. High healthcare spending shows up as economic strength in the statistics and as household strain in real life. Both things are true simultaneously. Manufacturing, around a tenth of output, politically enormous, statistically modest. And here's the nuance that gets lost. American factories produce more in real terms than they did decades ago. They just do it with dramatically fewer people. That gap, rising output, falling employment, is most of the reason industrial politics feels the way it does. Then there's the fifth thing, the one that isn't a normal sector at all: the build-out. Depending on how you define it, computing infrastructure investment has roughly doubled as a share of the economy, from something like 0.7% historically to around 1.5% now, with broader estimates of total AI-related capital spending running from under 2% up towards 5% of GDP, depending on what you include. Goldman Sachs estimates global AI investment crossing $1 trillion this year, with something approaching $600 billion of it in the United States alone. The disagreement about how much of America's growth this represents is genuinely wide. Harvard's Jason Furman calculated that tech and software investment accounted for over 90% of growth in one recent half year. ING's analysts put the figure closer to a third for 2026. Others argue both are too high once you properly subtract the imported hardware. What nobody disputes is the direction. This is now the marginal driver of the American economy, and it has a property that ought to worry you more than the bubble question. A data center is enormously expensive to build and employs very few people once it's running. It is a capital-intensive, labor-light asset, which means this boom pushes GDP up hard while pushing employment up barely at all. Hold that thought. It explains the strangest chart in this entire episode. If you like economics explained with the actual receipts rather than the vibes, subscribe. One system taken apart every week. And stay with me for the section on the labor market, because there's a number in there that looks like good news, is reported as good news, and is not good news, right? The jobs picture. This is where 2026 gets genuinely strange. The July report, the economy lost 23,000 jobs. Forecasters had expected a gain of around 80,000. And the unemployment rate went down to 4.1%. Both of those are true. Understanding how they're both true is the single most useful thing you can learn about economic statistics. The unemployment rate is a fraction. Unemployed people on top, labor force on the bottom. And the labor force only counts people who are working or actively looking for work. Stop looking and you don't become unemployed. You disappear from the denominator entirely. So there are two ways for that rate to fall. People find jobs, good, or people stop looking, not good. In July, it was substantially the second. The labor force participation rate fell to 61.4%, lowest in more than 5 years. It's down roughly 0.7 of a percentage point since January alone, and something in the region of well over 1 million people have left the workforce over that stretch. Some of that is population aging. A significant portion, analysts widely agree, reflects reduced immigration. Some is discouragement, and the revisions tell you the rest. May and June were revised down by a combined 103,000 jobs. Over the past 12 months, the average monthly job gain works out to about 34,000. For an economy this size, that is close to a standstill. So here's the honest summary of the American labor market. Unemployment is low by any historical standard, and hiring has nearly stopped. Those aren't contradictory. If almost nobody is being fired and almost nobody is being hired, the rate stays low and the experience is miserable, particularly if you're young or new to the country or trying to change careers. Long-term unemployment now accounts for about a quarter of all unemployed people, and unemployment among recent graduates has been running at its highest levels in about a decade. Now the wages, which is where it stops being abstract. Average hourly earnings recently ran about 3.2% above a year earlier. Consumer price inflation over roughly the same stretch, 3.4%. Do the subtraction. Wages are growing slower than prices. In real terms, the average American worker's hourly pay is going backwards and has been for several months running. That single gap, a couple of tenths of a percentage point, explains more about public sentiment than any political analysis you will read this year. When people say the economy feels bad while the statistics say it's fine, they are usually describing this. The aggregate is growing. Their purchasing power is not. Now the price level and the institution that manages it. Inflation ran at roughly 3.4% in the year to July, easing slightly for a second month. Core inflation, stripping out food and energy, came in around 2.5%, the coolest reading in years. That gap between headline and core tells you exactly where the pressure is coming from. Energy. Gasoline was running roughly 25% above a year earlier, fuel oil close to 40%. The cause is the conflict with Iran, disruption around the Strait of Hormuz, and the resulting shock to global oil markets that pushed pump prices sharply higher earlier this year. So the American inflation problem in 2026 is largely an imported energy problem sitting on top of an otherwise cooling domestic price picture. And that distinction is the entire reason the Federal Reserve is arguing with itself in public. Quick primer, because the Fed is genuinely misunderstood. It has two legal jobs, which is unusual. Most central banks have one. Stable prices and maximum employment. It targets 2% inflation. Its main tool is the federal funds rate, the overnight rate. Banks charge each other, which cascades outward into mortgages, car loans, credit cards, business borrowing, and the value of the dollar. Raise it and you cool. Demand in the labor market. Cut it and you stimulate both. The rate currently sits in a range of 3.5% to 3.75%. It has now been held there for 5 consecutive meetings under Chair Kevin Warsh. And at the most recent meeting, 3 members of the committee dissented. They wanted to raise rates. That is a remarkable amount of open disagreement, and the reason is that the dual mandate has split down the middle. Inflation is well above target, which argues for hiking. Hiring has stalled and the labor force is shrinking, which argues for holding or cutting. Cleveland Fed President Beth Hammack has publicly argued for acting now on the reasoning that waiting makes the eventual correction more expensive. Others counter that hiking into an energy shock punishes the economy for a price rise. Monetary policy cannot fix. You cannot raise interest rates and produce more oil. Markets have been swinging between a hold and a hike with every data release. And there's a deeper point worth making without partisanship. The Fed can only affect prices by affecting demand. When inflation comes from demand running hot, the tool fits the problem. When inflation comes from a supply shock, a war, a shipping lane, a failed harvest, the tool doesn't fit, and using it anyway means deliberately weakening the economy to offset a price rise you didn't cause. That is the actual argument happening inside that committee right now. There is no obviously correct answer, which is why serious economists are on both sides of it. Now, the federal balance sheet, and I want to do this carefully because it is the most politically loaded set of numbers in American life and also the most badly explained. Start with revenue. The federal government takes in somewhere around 17.5% of GDP. Individual income taxes and payroll taxes together do the overwhelming majority of the work. Corporate income tax is a much smaller slice, and this year it fell by roughly a quarter, around $86 billion. Largely because the 2025 reconciliation law let companies deduct certain investments faster. That's not evasion. It's the law working as designed. Whether it was well designed is a political question I'll leave with you. Then customs duties, tariffs, which we'll come back to because they had an extraordinary year. Now spending. Federal outlays this year run around $7.4 trillion, roughly 23% of the economy, against a 50-year average closer to 21%. And the shape of that spending is the thing to understand. Around 3/4 of it is mandatory. It happens automatically under existing law without Congress voting on it annually. Social Security, Medicare, Medicaid, interest on the debt. Congress votes each year on the remaining quarter, which includes the entire military, every federal agency, infrastructure, research, and everything else people argue about on television. So when you watch a shutdown fight, you are watching a fight over a minority of the budget while the majority runs on autopilot. The deficit, the annual gap, is now projected at about $2.1 trillion for this fiscal year, revised up by $200 billion from the earlier estimate. Total debt is running near $40 trillion gross, with debt held by the public at roughly 101% of GDP. The Congressional Budget Office projects that reaching about 120% by 2036, which would exceed the previous record set just after the Second World War. And here is the line that deserves far more attention than it gets. Net interest on the debt is running around $1 trillion a year. That makes it the third largest item in the entire federal budget, behind only Social Security and health programs, and ahead of national defense. CBO projects it roughly doubling to about $2.1 trillion within a decade. Think about what interest actually is. It is a payment that buys the country nothing. No road, no soldier, no cure, no classroom. It is the price of decisions already made, and it compounds. Now the honest counterweight, because doom is not analysis. The United States borrows in a currency it issues. It cannot be forced into default by running out of dollars the way a household or a business or a country borrowing in someone else's currency can. There is genuine, unresolved disagreement among serious economists about how much debt is too much, and predictions of imminent crisis have been made and missed for 4 decades running. But the constraint is real, and it isn't default. It's crowding out. Every dollar of interest is a dollar not available for anything else. And the trajectory narrows the government's ability to respond to the next war, pandemic, or crash. CBO Director Philip Swaggle's summary is about as blunt as that office gets. The fiscal trajectory is not sustainable. That's not a partisan statement. It is arithmetic that both parties have contributed to and neither has moved to fix. Now, trade policy, which had a year unlike anything in modern American history. And I'm going to stick strictly to what happened. For most of 2025, sweeping tariffs were imposed under emergency economic powers legislation. On the 20th of February this year, the Supreme Court ruled 6-3 in Learning Resources versus Trump that statute does not give the president authority to impose tariffs. That decision landed at 10 in the morning. Within hours, the administration invoked a different statute. Section 122 of the Trade Act of 1974, never previously used for this purpose, imposing a flat surcharge on most imports. That authority carries a hard statutory limit of 150 days and a maximum rate of 15%, and the president cannot extend it alone. It expired on the 24th of July. A replacement under Section 301 took effect the same minute. a two-tier structure of roughly 10 to 12.5% covering around 60 economies and the overwhelming majority of American imports. Meanwhile, a separate court found the Section 122 tariffs themselves unlawful in May. That ruling is under appeal. 25 states filed suit against the new Section 301 action in early August. And a refund process is grinding through tens of millions of import entries for duties already collected under the struck-down authority. Set aside whether you support tariffs. Just look at the structure of what I've described. The legal basis for taxing a large share of American imports changed 3 times in 5 months, with litigation running in parallel on all of it. Now the economics, and here I'll give you both sides properly. The case for tariffs raise revenue, create leverage in negotiations, and shift production incentives back towards domestic manufacturing. Supporters argue foreign producers absorb part of the cost through lower prices and that reindustrialization is worth a transitional price. The case against, most estimates suggest the cost falls largely at home. Research from the New York Federal Reserve found that more than 90% of tariff costs were borne domestically during most of 2025. Tariffs on intermediate goods, steel, components, raise costs for American manufacturers who use them, which is why the effect on employment is contested even among people who want more factories. The revenue side had a twist too. CBO raised the deficit projection by $200 billion this year specifically because tariff collections came in far below expectations after the court's ruling and the refunds it required. The applied tariff rate is still historically elevated. Tax Foundation estimates put it around 11.7% applied against roughly 1.5% in 2022. But the fiscal windfall some had projected did not fully materialize. One thing both sides agree on, and it's worth stating, the uncertainty has a cost of its own. When the legal basis for import taxation changes 3 times in 5 months, businesses defer investment decisions, and deferred investment is growth that doesn't happen. So, pull it together. Who's winning? First, owners of assets decisively. The clearest fault line in the American economy isn't left and right or coastal and interior. It's whether you owned things before prices rose. If you own a house and a stock portfolio, the last several years have been extraordinary. If you rent and earn wages, you've been watching prices outrun your pay while the assets you'd need to buy get further away. Same country, same statistics, opposite experience. That gap is most of what people are describing when they say the economy doesn't feel like the numbers. Second, a very small number of very large firms. A handful of companies are responsible for an enormous share of the capital spending currently holding up national growth. That concentration is the source of both the strength and the fragility. If their spending plans hold, the tailwind holds. If they slow, because returns disappoint or power capacity runs short or credit tightens, the build-out doesn't shrink gradually. Capital expenditure programs turn fast, and underneath that build-out is an economy that has been growing very slowly on its own. Third, quietly, the creditors. Somebody receives that $1 trillion of annual interest. Pension funds, foreign central banks, banks, insurers, and American households holding treasuries. The debt isn't money vanishing. It's a transfer from taxpayers broadly to bondholders specifically. Bondholders, on average, are wealthier than taxpayers on average. That is a redistribution nobody voted for and almost nobody discusses. And the structural advantage underneath all of it, the one that outlasts every administration, the dollar. Because the world settles trade and holds reserves in dollars, America can run deficits that would have already broken any other country, and borrow at rates its fundamentals alone would not justify. That privilege is what makes the whole arrangement work. It is also the single thing most worth watching over the next 20 years, because it was never guaranteed, and it isn't a law of nature. So here's the honest verdict. The United States in 2026 is not booming and it is not collapsing. It is an economy with a low unemployment rate and almost no hiring, cooling core inflation and an energy shock on top. Enormous investment concentrated in a handful of companies building infrastructure whose payoff is still unproven. Real wages slightly negative, a trade policy that changed legal foundation 3 times in 5 months, and a fiscal path that everyone who examines it professionally describes as unsustainable on a timeline distant enough that nobody has to fix it this year. The headline number will keep saying growth. And it won't be lying exactly, it just won't be telling you which economy the growth happened in.